Robert A says, I opened a 28th of January Tesla 1145, 1140 bear put debit spread today. Okay, so let's just do Tesla and let's just build this position. 28th, 1145, sorry folks. 1145, 1140 bear put debit spread. What does that mean? It means he's selling the 1140 deep in the money put and buying the 1145. Now, let's scroll down here. Sorry about that. Long chain. Okay. So there we go. There is our bear put debit spread for the Tesla position. That's pretty good. Yeah, 1040 there. 1049, excuse me, 1050 essentially is the stock price. We sold an 1140 put, which obligates us to deliver shares of stock at that price. And we also bought an 1145 put, which gives us the right to force someone to buy our shares of stock at 1145. So the strategy here, of course, if the stock remains below 1140 on January 28th expiration, you could close out the position. The debit was 382.50 using the midpoint prices that I just grabbed. It's probably different, a little bit different on Robert's price there. But if I close out the spread and get close to the full 5 points back, in other words, the stock's anywhere below this, I can sell this for almost 5 points of intrinsic value higher than what we would have to buy back the 1140 for. We'd get 118 back on the position. So the profit's around 30%, 28, 29%, somewhere in that range. Now, Robert's follow-up question on this bear put debit spread, which as we just discussed a moment ago for Robert B, would be a parity trade to a bear call credit spread with the same strikes, but you'd taken a credit up front, maybe of $118, but you'd have a risk of 382.50 because you have to put up the 5 points to cover the bear call credit spread. Robert wants to know, what are my options in terms of management if it starts to go against me? How do I compare this to a similar call credit parity? Okay. First things first, Robert, as you know, we do have that. Let's go to YouTube real quick. We do have that one webinar on 8 ways to manage a oops, sorry. Sorry about that. 8 ways to manage a bull put. Now, you're familiar with that. I think we've talked about it before, Robert, but you could use those basic principles. Oh, shoot. Sorry, folks. You could use those basic principles and just reverse them. Okay, let's try that there. 8 ways, that's the full one from 3 years ago, the full hour and 17-minute presentation. There's a couple reviews here as well. There's 8 ways to manage a credit spread. That's from 1 year ago, where we talk about bull and bear a little bit. There were 2 Swift Skills presentations that we did 3 years ago. This one here is just 2 minutes long. It reviews the 7 ways to manage a bull put credit spread. We added one later. There's the pendulum adjustment you could see. There is also one on bear calls. So let's do manage bear call. Let's search manage bear call. And so there's some videos there. 7 ways to manage a bear call credit spread from 5 years ago. And this is the 2-minute long Swift Skills one, which is just video slides with some music in the background there, Robert. So you might want to check those out later. Why am I bringing up bear call if we're talking about debit spreads? Well, essentially the ways that you'd manage a bear call or the ways I would manage a bull put are the exact same ways I would manage a bull call, but just thinking of the idea as a call debit spread rather than a put credit spread. Same ways I'd manage a bear call is the same ways I'd manage a bear put debit spread. We'll talk about some of those in just a moment. Here's evaluating ways to manage a debit spread, ways to manage a bear put debit spread. That's from 7 months ago. It's a pretty decent one to check out in that case. Okay, so that's for later on when you have the time, Robert, before we get to it. But let's go back to our custom spread. As you've heard me say, with a bull put credit spread, or if this was a bear call credit spread, I'm going to set the same type of alerts that I would for that other spread position. Meaning that I don't know how you open Tesla, but normally if I open a bear call or a bull put debit spread, I'm looking for a stock that's below the SMA 20 or SMA 50. In this case, since we're only out 14 days, I'd be below the SMA 20. And I'd be looking for a negative MACD, where the MACD is trading below the signal line in that case. I mention this because whatever technicals you feel that you used, whether it was a technical to say there's no way that Tesla is going to be up to 1140 in the next 14 days based on what you analyzed, if you used Fibonacci, however you used it, whatever technicals you use, if you start to see these turn, in other words, if I was in a bear call credit spread following my criteria and I saw the MACD go positive and then the stock rose above the SMA 20, I'm starting to get concerned that I might start to think about ways to adjust or manage the position. In this case, I'm still setting an alert with the 1% rule, meaning if the stock reaches within 1% of my short put strike price in this bear put debit, or within 1% of the short call strike price of the bear call credit, I'm going to think about managing the position. So in other words, we sold the 1140. So 1050 here is 1%. So 1050, off of the 1140, that would put us at 1129.50. So if the stock reaches 1129.50 here, right around 1130, I'd start consider maybe moving this position. Now, there's one aspect in the 8 ways to manage a bull put credit spread or a bear call credit spread that is not available in the debit spreads. Well, what are the basic ones? Okay, first is if the stock starts to go against your technical trends, reaches within the 1% rule, you're near a 50% loss on the position, meaning you put in a debit of, let's call it 385 here. If the liquidation value is less than 190, for example, or 185, you're down 50%, then you might want to consider just closing the position. You're wrong on the direction. Don't allow that loss to get any bigger than 40 or 50%. Close the position, take the loss, make it back with your trading plan on other strategies. It's not the most popular one, but it saves a lot. If it starts to move against you quickly, closing it and taking a loss of 40% of your maximum loss as opposed to allowing that to go to 80% or 90%, where you might be wiping out 4 or 5 previous trades, it's never a bad idea to close. Number 2, of course, I think we talk about in the bull and bear call credit spreads is not here. If I'm in a bear call credit spread, a parity trade, Robert, to this bear put, and the stock rose to this point, and it's going to be expensive, I know, because it's Tesla. But one thing I could do in a credit spread is just close the short. So if I close the 1140 call for a high price, but Tesla continues to move up, then I'm essentially now just in a long call position. You really need more time for that to work. So if I entered this bear call and next week on Tuesday or Wednesday, the stock started to quickly move against me, and I still have 12 days to go, 10 days to go, maybe 8 days to go, I think there's time for it to still go above 1145, where the gain in my neo long call would counter the loss that I took from buying back the short call. I would use that. This is the one we can't do in a debit spread. We can't close the short and leave the long open. It doesn't make any sense because I'm in a bear put here. So even if I close the short put and the stock continues to go up, this is losing more. So that's off the table. And you don't want to do the opposite, in my opinion. Meaning that say, oh, well, if the stock continued to go up, then my short call would be out of the money. Why don't I sell to close the long? Sell to close the long put quickly. So now if the stock continues to move up, this short put, my apologies, would be out of the money and expire worthless. Well, now you're in a naked put at 1140, and that's going to be a high margin requirement. Another one that you don't have advantage to do here, not because it's a debit spread instead of a credit spread, Robert, simply because you don't have the opportunity. Sometimes what I would do is buy back the short and move it to the next strike price. So if you're in a 10-point spread here, the 1140, 1150, your 1140 sold put was being threatened, you might still be able to make a profit, but a smaller profit, by buying to close the short and rolling it up one strike. Now you'd be in an 1145, 1150 spread, a little bit more room with still some time left to go to expiration. My return might drop down from this 28% down to a 10% return as long as it stays below 1145. So that's move the short one leg, move short leg one. Okay, but to do that, you have to leave a strike in between, which on some stocks that greatly increases the margin. Number 4, of course, is the common one that's done. It's not always the best idea. It's close the position, in a sense, really roll it. So you'd close the 1140, 1145, maybe go out 2 more weeks and go to 1160, 1165. So, close and roll out. Really, it's just roll out, but the act of closing it first, you can roll it true, but you're effectively closing one and just opening the other. So you're just moving the one spread to a further out spread and likely lower your profit as well. Number 5 we usually talk about is close and do the opposite. You were wrong on the direction of this position. The stock started to move against you, and it's now showing a bullish trend, which is always important, which we discuss in most of those webinars. When it starts to threaten the sold option in your spread position, look at the chart again, especially before doing number 4. Instead of just saying, oh, I can always roll the position, just like I roll a covered call or roll a naked put, I can just close the spread, roll it out, go to higher strike prices for my bear call or my bear put debit spread, and I'll be fine. If it keeps going, you're locking in the loss of the first one. Now you're taking a loss on the second one. It's not going in the wrong direction. So before just rolling out, you want to analyze, seeing what the new technicals are in this position. Would you do the same thing? Would you open a bear put debit or a bear call credit spread on this stock right now, if that was the case? If the answer is no, then look at 5. Close this spread. Now maybe open a bull put credit spread or a bull call debit spread, because that's the direction the stock is going. Okay, number 6. Let's forget this one, but I get 6 and 7 confused. But you could enter in the credit spreads. We talk 6 or 7 is an iron condor position. So if I'm in a bull put and it starts to get threatened, I might add a bear call to it. Does that stop the loss on the bull put? No. What it does is it gives me another net credit to give me a wider break even to the downside, but it would also create an upper break even. So now I have 2 break evens. I'm in that flat plateau, profit and loss chart of an iron condor position, where my lower break even and my now created an upper break even, but this moved down slightly because of that new net credit. Gives me a little bit more room. However, now I put myself in 2 ways to lose. And what it doesn't do is, if the stock's going against your bear put debit, you're not creating an iron condor, you'd be creating a debit condor. You could open a bull call debit spread down here. Here we go. And sort of just create a debit condor position effectively. And so if it comes back down and stays in this range, you make on this one and you make on this one, which would do the same things. It would change the break even slightly in your favor in that case. And let's see here. Let me go 1 second. So that's the iron condor one. Oh, I'm sorry, folks. I was on the wrong view there real quick. Let me just review real quick something here. I'm trying to think of the one I'm missing. If anyone knows, if anyone remembers it, let me know. But I did this the last time we did the review, and I forgot number 6 or 7. Oh, and it's not the right screen there. I thought on one of these I had the screen showing all 8. Maybe it's the review. 8 ways almost. Okay, in any case, one of the last ones we discussed for the ways that you can manage a credit spread or a debit spread is the pendulum adjustment. Okay, it's really fun. I like it a lot. I use it maybe twice a year. Let me clear out our drawings there so that we can get a cleaner view. And I'm actually going to use a different position, Robert, in this case. And what I'm going to use is, what was I looking at today? AIG. I almost opened a married put today for the Fusion subscribers on AIG. Lisa, yeah, I did say close and do the opposite. I had that one in there, I think, at number 5, and then 6 was the iron condor. I had to close one leg, close the short only. Lisa says 7 is close the short only. I put that at number 3, I'm sorry, in our discussion. So I got the numbers wrong. I'm sorry, AIG. I'll find it, don't worry. was it 61, I think. So I want a bear put debit. I'm going to go next week. Bear put debit. Let's say I sold the 60. That's good. Bought the 62.50. Let's do that. Okay. And let's get a wider view here for better profit loss. Now I just entered this position. Let's say that we had a better debit. Let's say we sold this 2.5 point spread. So let's say we sold this at 85 cents and we bought this at 3. That sounds good. 320. Maybe 320 is too high. I'm looking for around a 12% return. 6.4. Okay, yeah. 320 is too high. It's not going to double it, but in that case. All right, so 16.3 is pretty good. So let's say when AIG was trading at around 57 at some point, I decided to do this spread here where we sold the 60 put and bought the 62.5. And now the stock is between the strike prices. What we talk about in the pendulum adjustment position is rather than, as we just talked about with Lisa, even though the numbers on one webinar are different than the ones I started to present here, I am going to leave, I swear, I'm going to leave a note right over here, a post-it note, 1, 2, 3, 4, 5, 6, 7, 8, so I can reference it every time this question comes up. Sorry. In any case, the pendulum adjustment, instead of closing the position and opening the opposite, so if my bull put was threatened, I'd close the position and convert it into a bear put debit spread by taking the long and swinging it down. In the debit spread, I could do the same thing with the pendulum. It usually works best when the stock is right between the strike prices. And what I'm going to do is sell to close this put, even though it's declining in value, and I'm going to buy to open a lower strike put. So with one move, I'm going to convert my bear put debit into a bull put credit spread, because now the stock is going in the opposite direction. Does it always work? No. I think it's going to work on this one? No, I don't, but let's give it a go. So what I'm going to do is sell the long. 7 days out, we're going to sell the 62.5 put, which is losing value, and I'm going to buy a 57.50. So I'm going to get $1 back, $1.10, $1.12 back, and I'm only going to use I'm only going to pay about 16, 18 cents. So what are we doing? We're selling to close our long put, buying to open the lower strike put, same expiration. It didn't work. So sometimes what this does is, as you're losing now on that bear put debit, rolling the one leg to convert it to a bull put might get you to a profit. I started off with a 16% profit. This is going to lower it down maybe to 1%, 2%, or 5%. Hey, that's better now that the stock is going in that general direction than taking a 40 or 50% loss on the bear put. This one didn't work. I could see it wasn't going to work just by the numbers here, but it's an opportunity to do that. A question always comes in, well, could you do the same thing, convert it to a bull put spread by rolling the short? That's not what I want to do. Okay. Why? Because if I rolled the short, yes, the stock's almost up here to 62.50. It's not above my long put yet. Meaning what? That if I rolled from my 60 put for no cost, well, it had a cost, right? It was 20 cents. Okay, 35 cents. So if I bought to close the 60 and rolled up to the 65, this would convert your bear put debit into a bull put credit spread as well. But both strike prices are in the money. That's not what I want. I want it to be out of the money if it was still profitable while the stock's going up. Now that the stock's been breaching, yes, we think it's going to move back up. But I think it's going to hit 65 in 7 days? No, that's too much. That's too low of a probability of that happening in that case. So that's not how you do it. The pendulum adjustment is moving the long, swinging it down one to do that. And Lisa, yes. So when I said I was going to look for something real quick, when I had the discussion on pause, I went to YouTube to look back for it, and oh, maybe it is. Hold on 1 second here. I don't want to start playing it though. Let me go. There it is. Okay. Good. Because then you'll hear the volume. That's why I didn't want to play it, Lisa, because I was trying to mute it, but I couldn't do that. So number 1 is do nothing. Oh, that's the one I always forget. That's the one I always forget. That's not number. Oh, I can hear it now. Hold on. All right. The one I always forget. Let's go back to our main bear put debit spread. Oh, no. I want to go back to Tesla, but we'll stay here for now. Okay. So, yeah, in this case, I wouldn't choose it in this case, but if your Tesla example, let's put it back in. It's not going to take too long here. So we're doing 11/40, 28th, right? Yeah, 14 days away for Tesla. Yeah, I know. I'm sorry. I paused the screen for you guys so that you're not seeing all the scrolling in the large Tesla chain to get to the strikes that we want here. So we're selling the 11/40, buying the 11/45. I'm just going to keep the existing prices that today's prices, excuse me, in that case. There we go. All right. There's our Tesla spread. Yeah, and we're not close to it yet, but again, that's the one I always forget. I always think of action first, not inaction. So number 1 is do nothing. Hey, I've got 2 days left to expiration. It came up to my 1% rule. It's trading at 11:39. I'm sorry, 11:29, 11:30. But I don't think in the next 2 days it's going to keep up and go to 11:40. The strike price that we have. We're sitting here at about 11:30. I don't think it's going to hit 11:40 in 2 days. That's a big gamble with this position, obviously. But again, I can choose to do nothing. Just sit and wait, and then if it continues to go against me, then I can do more of an active management. And number 2, of course, that was our close and take the loss. Okay. Number 3? I'm sorry. One second. Okay. There we go. Okay. So now 3. Whoop. Number 3, of course. Close the short. This is the one that we can't do. Okay, we don't do this in a debit spread. It's only done in a credit spread. Number 4, roll the whole spread out. Liquidate, roll the whole spread. Move it, roll the whole spread out in time and to different strike prices, perhaps. There we go. Sorry about that. As the 7 was the condor, right? And this was 6 was close and do the opposite. I think 5 was move the short strike 1, which you can't do in this structure. Move the short strike. And then, of course, the pendulum. So that's essentially the debit spread ones, rough order. We can't do just close the short. And again, I don't want to do the reverse, Robert, and close the long if the stock continues to go up, because now that's a naked put that I have to put up the full margin for. And if I'm in a bull call debit spread, I don't want to panic sell the long option as it's losing value and be in a naked call, because if it reverses, now I'm stuck in a position where it has that as well. Yeah, this is, Lisa, you keep saying it, roll the short only. That's this move 1 strike. That's what I mean. Roll the short only. That's the move 1 strike. Okay, I don't mean move the whole spread 1 strike. Sorry if that was confusing. Number 5 is move the short only, but that's not available in this case either, because there's no strikes between. So in this case, if it starts to get threatened, Robert, in the spread that you're in, you do nothing, close and take the loss, roll out to a new debit spread, but remember, analyze the stock first before just rolling out to a new bear put debit spread. Why are you managing this bear put debit spread? Because the stock's going the opposite direction that you saw, that you thought. And if it continues that direction, you could lose on the second spread. So this one, got to analyze the stock first. Close and do the opposite. I'm going to close my bear put debit spread, do a bull call debit spread, or a bull put credit spread. Create the debit condor, or if it ends up just suddenly jumping up and is between the strikes, analyze that pendulum adjustment to convert your bear put to a bull put that'll have a lower profit with just one move as well. There are other ways to manage positions, of course. I mentioned, somebody mentioned, it was Jim. Jim says you can always do a butterfly. I left that into number 7. So what we were talking about here with a condor is if the stock starts to get up here, I might do that bull call debit spread to create a debit condor position, which would move my break even up. Jim's not wrong. You could do a butterfly too. So as it's moving up, I could sell another 1140 put and buy an 1135 and do a 5-point bull put spread, which would give me a credit that's extremely high now because it's at the money, which would move my upper and lower break even this way, and we'd end up in a all put butterfly position. I lump that in with the condor. I should really call it condor or butterfly. But the reason I don't like to manage personally with a butterfly is because I know that now I have to manage one side of that new spread either way. They both can't expire worthless. There's no way Tesla's going to end up right at 1140 and stay right at 1140 on January 28th at 4 p.m. and stay that way to 4:55 p.m. when everything is settled. It's not going to happen. So to avoid the fact of definitely knowing I have to manage one side or the other as we get closer to that Friday expiration, even though I'm getting more bang for my buck, Jim, absolutely. Meaning that if I'm managing a bear call with a bull put and I'm doing an out of the money bull put to create the condor, I'm getting a lower premium. Yeah, I might be getting 30 cents or 40 cents in that position. When I'm doing an at the money, now that it's threatening my 1140, I'm at the money bell curve. I'm getting a huge premium here. So my butterfly is going to jump up like this, where I have a small loss maybe over here, a small loss over here, have to put up the 5-point margin, but there's no way it's going to stay right there. I'm going to have to either close out this portion of my bear put debit or this portion of the bull put credit if it starts to fall back again. I've got to close that short put, especially if it falls, because I don't want to get assigned 1140 if my goal is not to own the shares of stock. But yes, I lump that butterfly in with the condor. It is a possibility, but I just don't like the secondary thought of knowing I actively have to manage one side or the other if converted to a butterfly. Whereas hopefully if I do a condor and everything happens the way I want, the broker just closes them out for me as well. Okay. All right. So that's a quick review for you, Robert. And you can take a look, as I mentioned, at some of those videos on YouTube there. Let's go back one into the search, and you can do the debit spread screen. I think it was manage a debit spread. Let's try manage a debit. Value, yeah, so there's some older ones there, 12 minutes long. Ways to manage a bear put debit spread, 33 minutes long. That one might be really good for you. A better review, perhaps, of the 7 ways to manage a bear put debit spread position. Elisa says, how about a swap with different spread, which is on a bullish trend? Risk reward in the new spread is much better than the existing one. A swap with a different spread. Well, that's what we talked about, is close and do the opposite. I think, Lisa, I'd close the bear put debit and open a bull call debit or a bull put credit spread. That's the close and do the opposite.